Hi, this is the second complete comprehensive example where we will deal with adjustment of capital sums in the chapter of retirement of partner. We will be dealing with the first method of adjustment of capital where the total capital of the new firm is given. So let's go to the example sum. Example sum. On 31st March 2019, the balance sheet of A, B and C, who were sharing profits and losses in proportion to their capitals, stood as follows. To the left of the screen, the balance sheet is given, and to the right, B retired, and following adjustments were agreed to determine the amount payable to B. A. Out of the amount of insurance premium debited to profit and loss account, ₹1,000 be carried forward as prepaid insurance. Point B. Freehold premises be appreciated by 10%. Point C. Provision for doubtful debts is brought up to 5% on debtors. Point D. Machinery be reduced by 5%. Point E. Liability for workmen compensation to the extent of ₹1,500 be created. Point F. Goodwill of the firm be fixed at ₹18,000 and B share of the same be adjusted into the capital accounts of A and C, who will share future profits in the ratio of 3/4 and 1/4. G. The total capital of the firm is newly constituted be fixed at ₹60,000 between A and C in the proportion of 3/4 and 1/4 after passing entries in their accounts for adjustments, that is, the actual cash to be paid or to be brought in by the continuing partners as the case may be. Point H. B be paid ₹5,000 in cash and the balance be transferred to his loan account. We are asked to prepare the revaluation account, partners' capital accounts, and the balance sheet of the reconstituted firm. Now the first sentence, which says the balance sheet of A and B is given, who were sharing profits and losses in proportion to their capitals. So to get the profit sharing ratio between A, B and C, it's equal to 45,000 is to 30,000 is to 15,000. So this is equal to, dividing throughout by 15,000, 3:2:1. And the partner who's retiring is partner B. Further, the G subdivision says the total capital of the new firm is to be fixed at 16,000 between A and C in 3:1. So we know that this is the first method of adjustment of capital where the total capital of the new firm is given. And the adjustments need to be made through cash, because it says here actual cash to be paid or to be brought in by the continuing partners as the case may be. So we need to make the adjustments through bank account. So let's go ahead with the solution. We'll start with the revaluation account, go on with the partners' capital accounts, and finally the balance sheet. We'll put the working notes after the balance sheet. Solution. Revaluation account. Left side debit, right side credit. Particulars. Rupees. Particulars. Rupees. Let's begin with point A. Out of the amount of insurance premium debited to profit and loss account, ₹1,000 is to be carried forward as prepaid insurance, an unrecorded asset being brought into existence. So we have by prepaid insurance account ₹1,000. Point B, freehold premises to be appreciated by 10% by freehold premises account, 10% of 50,000, 5,000 rupees. Point C, provision for doubtful debts to be bought up to 5% on debtors. So 2, provision for doubtful debts. 5% on debtors, 5% of 10,000 comes to 500 rupees. Existing provision is only 200 rupees. So we will increase the provision by 300 rupees. Point D, machinery be reduced by 5% to machinery account. 5% of 24,000 rupees is 1,200 rupees. Point E, the liability for workmen compensation to the extent of 1,500 be created. There is no workmen compensation reserve. So for the entire amount of 1,500, we need to create an unrecorded liability. 2, workmen compensation claim account, amount 1,500. Point F deals with goodwill. We'll ignore that for now. Point G is about the adjustment of capital. We'll ignore that also. And point H is about settlement to retiring partner B. So we completed the entries in the revaluation account. Let's balance the account. Greater total is on the credit side, 6,000 rupees. There's a gain on revaluation, 2 gain on revaluation, transferred to partners' capital accounts. Partner A, partner B and partner C. Total of the credit side is 6,000 rupees and the debit side total comes to 3,000 rupees. So we have a gain of 3,000 rupees, which has to be divided in 3:2:1, the ratio of the capitals. So it's 1,500 against partner A, 1,000 rupees against partner B and 500 rupees against partner C. This is a revaluation account. Let's go ahead and prepare the partners' capital accounts. Partners' capital accounts. Left side debit side, right side credit side. Particulars: A, B, C. Particulars: partner A, partner B and partner C. We'll begin by bringing down the balance of the capital accounts. 45,000 rupees, 30,000 rupees and 15,000 rupees. We'll transfer the gain on revaluation by revaluation account. It was 1,500 for partner A, 1,000 rupees for partner B and 500 rupees for partner C. There are no reserves on the liability side and no accumulated profits either. No accumulated losses of fictitious assets on the asset side. There's no existing goodwill also. Let's deal with point F. The fresh valuation of goodwill of the firm is 18,000. So we'll go ahead with working notes for treatment of goodwill. Working note 1, treatment of goodwill. So as per the problem, old profit sharing ratio between A, B and C is equal to 3:2:1. B is the partner who retires. Further, it's given that firm's goodwill is equal to, as per point F, firm's goodwill is equal to rupees 18,000. Hence, B's goodwill, B's share of goodwill should be equal to 18,000 rupees multiplied by 2 divided by 6, which is equal to rupees 6,000. Now, as per point F, the NPSR between A and C is equal to 3:1. Now, if the NPSR is equal to 3:1, the gaining ratio should also be equal to 3:1, because we say that where no information is given, the gaining ratio is equal to the NPSR is equal to the OR between A and C, which is 3:1. So the NPSR is given as 3:1, therefore the gaining ratio between A and C should also be equal to 3:1. So let's pass the journal entries. A capital account debit, C capital account debit, to B capital account. 6,000 rupees, B share of goodwill against B's capital account. This has to be divided in gaining ratio 3:1. So we have 4,500 rupees against partner A and 1,500 rupees against partner C. Let's post this in the partners' capital accounts. By A capital account, under B we have 4,500 rupees, and by C capital account, again under the retiring partner B we have 1,500 rupees, and to B's capital account, under A we have 4,500 rupees, and under C we have 1,500 rupees. We've dealt with goodwill. Let's close the account of the retiring partner. It says B is to be paid 5,000 in cash and balance to be transferred to loan account. So to bank account, 5,000 rupees, and the balancing figure will be transferred to B's loan account. $37,000 greater total minus 5,000 rupees, amount transferred to B's loan account 32,000 rupees. Now let's go ahead with the adjustment of capital working note. Working note 2 is for the adjustment of capital. Step 1, we need to get the new capitals of A and C. As per point G, total capital of the new firm is 60,000 rupees, and to be in the NPSR 3:1. So new capital of A is 60,000 rupees into 3/4, which is equal to rupees 45,000. And in the case of C, it's 60,000 rupees into 1/4, which is equal to rupees 15,000. The step 2 is to calculate the adjusted capitals. That is the capitals of A and C after all adjustments are done. The top screen we will adjust to show the partners' capital accounts. So in the case of A, it's 46,500 rupees minus 4,500 rupees. So it's rupees 42,000 adjusted capital of A, and in the case of C, it's 15,500 rupees minus 1,500 rupees, which is equal to rupees 14,000. So we have the adjusted capitals of A and C also. Step 3 is to compare adjusted capitals and new capitals. In the case of A, adjusted capital is 42,000, whereas the new capital is 45,000. A has to bring in cash into the firm for the difference amount, which is rupees 3,000. In the case of C, the adjusted capital is 14,000 and the new capital is again greater than the adjusted capital. Therefore, C also has to bring in cash of rupees 1,000. So let's post this into the partners' capital accounts. So by bank account, 3,000 rupees against partner A and 1,000 rupees against partner C, and to balance carried down the new capitals of A and C, which is 45,000 for partner A and 15,000 for partner C. If both sides tally, then we know that our arithmetic is correct. 49,500 total of credit side for A is equal to the total of debit side of A. 16,500 total of credit side of C is equal to 16,500 total of debit side for C. This is the partners' capital accounts in the top half of the screen. Next, let's prepare the balance sheet. Balance sheet as at 1st April 2019. Left side liability side and right side assets. We will begin with the liability side items. First item, creditors. No change in value, 10,800 rupees. Next item, bills payable. Again, no change in value, 5,000 rupees. Now, as per point E, there's a workman compensation claim of 1,500 which we created. So, workman compensation claim of 1,500. The retiring partner, B loan account. Amount of loan payable to partner B is 32,000 as per the capital accounts. So that's 32,000 rupees. And the capital accounts, partners' capitals. In the case of A, the capital was 45,000 rupees, the new capital. And the case of C, the new capital was 15,000 rupees. 60,000 total. We get this from the capital accounts. The balance carried down, 45,000 and 15,000. Cash at bank. the opening balance of cash is this 13,000 rupees. Now, as per point H, we paid rupees 5,000 to partner B, the retiring partner. So I'll deduct 5,000 rupees, and from the adjustment of capitals, A brings in 3,000 rupees and C brings in 1,000 rupees while adjustment of capitals. So it's plus 3,000 rupees and plus 1,000 rupees. So final amount is 12,000 rupees. Debtors, original amount 10,000 less provision for bad and doubtful debts. We created a 5% provision, so it was 500 rupees. Outer column 9,500 rupees. Stock, there is no change in the value of stock, 9,000 rupees. Machinery, we reduce machinery by 5% or 1,200 rupees. So now it's 22,800 rupees machinery. Freehold premises, we appreciated the amount by 10% or 5,000 rupees. So it's 55,000 rupees. And the first point A, out of the amount of insurance premium debited to P&L account carried forward as prepaid insurance is rupees 1,000. So that was an unrecorded asset. So prepaid insurance 1,000 rupees. Let's check if the balance sheet tallies. Liability side total 1,09,300 rupees. Asset side also totals to 1,09,300 rupees. So this is the balance sheet. I'll remove the split. We can view the entire answer together. So we began with the revaluation account. Followed by the partners' capital accounts. And the balance sheet. The working notes at the end of the sum. The first working note was for treatment of goodwill, and the second working note was for the adjustment of capitals.